Good afternoon, everyone, and thanks for joining us. I'd like to welcome you to this Monday Minute Live Chat hosted by the Canadian Leadership Congress. And our topic today is Asia's post-pandemic future. Before I begin, I have a couple of housekeeping and technical notes to cover. Please make sure your audio volume is properly adjusted. And if you're experiencing any audio difficulties, just refer to the audio pane located in the upper right side of your screen. You can also select phone call to hear the presentation on your phone. While watching it on the screen, just dial in and access code instructions will then pop up. And of course, during the presentation, you're welcome to download papers from our resource center, which you'll find along the side near the chat pane for more insights on Asia and Canadian pension investors. Now it's my pleasure to introduce our panel. Kevin Bong is Managing Director, Economics and Investment Strategy with GIC in Singapore. Daire Dunne is Director, Multi-Asset Strategies, APAC, and Portfolio Manager with Wellington, also based in Singapore. And our moderator, Marlene is CEO and President at CN Investment Division and is also a member of the Canadian Leadership Congress Advisory Board. So I'm going to pass things over to you, Marlene, to get things started.
Thanks very much, Caroline. I'm very excited to have these two fine panelists joining us from Singapore. So we'll just dive right in. We'll start with talking about the effect that COVID-19 has had on the different countries throughout Asia. They're not at the same stage of development, and the pandemic has played out very differently in different economies. So Daire, can you give us a little insight into how things have differed and how the various economies are adjusting at this stage of the pandemic's playing out?
Sure. Hi, everybody. Marlene, I think you're dead right. We're used to talking about Asia as some sort of large homogenous monolith, and the reality couldn't be further from that statement. You've got a range of GDPs per capita around Asia, from Singapore, where we're sitting, which is, generally considered a pretty wealthy, developed economy at $65,000 GDP per capita, all the way to South Asia, which on average GDP per capita is less than $2,000. So you've got an amazing array of economic starting points, and that just gives a flavor for the different ways that it's impacted different countries. So at the very start of the COVID outbreak, we built a framework looking at a whole variety of different variables that looked at human vulnerability as well as economic vulnerability. So that was a big, messy, multi-factor model. But actually, if I was just to pull two variables out of that model that I think are worth considering, on the human vulnerability side, it's demographics. So what proportion of your population is over the age of 55? And that's a pretty simple number to track. I think what we find globally is that's the most prone age group. And actually, even within that, we see big dispersions around Asia. You look at a country like Korea, which I think, or Japan, which are well known to have older demographics. In those countries, 50% of the population is in that older age demographic. And then you look at countries like India or Indonesia, the number is 20% or less. So that's a very different human vulnerability picture, which I think is worth considering. Then on the economic vulnerability side, you can look through all of the data, but the one that really jumps out to me as being most effective and most useful for thinking about the problem, it's the amount of informal labor you've got within your economy. If you have an economy that has a very informal labor force, you cannot afford to shut down for very long, because there's no social security backup. Those people don't get paid when they don't work. So you look at countries like Indonesia or India that I've already mentioned, 75 to 80% of the economy works in the informal labor force. So even though a country like India is leading the world today in terms of individual counts of COVID at 90,000 a day, the economy is back up and running and people are back at work because they couldn't afford to shut down for very long. So that's the economic reality. So I think those two variables are worth tracking. And actually, that's given us a pretty good picture of where the vulnerabilities have been around the region. And Singapore, where we're sitting, and Kevin knows this very well, it's a very formalized labor force here. It's a very wealthy economy. It's a somewhat older age demographic. So as a result of that, we've taken a very cautious approach because the country can afford it and the age demographic leans that way. But across Asia, the picture is very different. So I think I just leave the audience with those two variables to think about as it relates to the Asian region. And actually, I think that they've proven very useful as we've thought about where the vulnerabilities stand.
That's excellent. Thank you very much. And Kevin, what's your perspective? Have you, as a big institutional investor, really found a lot of differentiation across the region, and what are you keeping your eye on?
Yeah, thanks, Marlene, and hello everyone. I agree very much with what Daire has described. I think that there has been significant differentiation. I mean, across the globe, and certainly in Asia as well. And the dimensions that Daire described are ones that we've been keeping close watch on as well. I would say you would see that there have been some countries that have been struggling to flatten the curve as it relates to the pandemic in particular. And also the starting conditions of each of the economies really changes the nature of how the I suppose their economies will evolve over time. We're looking at it almost as a first in, first out approach to thinking about each of the individual countries, and in many ways, again, it reflects also the capabilities in the healthcare systems and the ability to test, to trace, to treat, to contain. And here you're seeing successes, primarily again and unfortunately, or at least fortunately, the slightly more developed economies, so China, Korea, Taiwan, Singapore has been fortunate in some ways as well. But there are a whole host of other countries in Southeast Asia that are still, and some of them struggling to flatten the curve, some of them certainly not having the healthcare infrastructure to be able to look after, I guess, all the people who might be affected by this. And certainly not many have the policy space to be able to support the economic devastation that's occurring as a result of the lockdowns, as a result of demand destruction and some of the supply shortages as well.
Are there any of the countries, for example, perhaps China, that has emerged earlier than the others, where we can learn in particular some better ways to handle this that perhaps the other areas of Asia or the rest of the world could view as the example to set?
I would say there are lessons that different countries definitely bring to the table. It does appear so far that the ability to be able to enforce a certain level of physical distancing, to be able to contain mobility when necessary, which is based off of really efficient testing and tracing, as Korea has demonstrated, for example. Is an element that would be helpful as we continue to await a vaccine. I think that the mobility restrictions are definitely something that are not always socially acceptable, and that in and of itself creates its own set of challenges. Clearly, given seasonality right now, it will be a bigger challenge for some countries than for others. Within Singapore, and Daire can definitely speak to this too, because he's experiencing it firsthand as we all are here. The lockdown was gradual to begin with, became a much more significant one, but it did help to significantly reduce the number of cases, and with a gradual reopening, with much better controls, with much better ability to actually kind of trace cases as they occur. I think that there's room for some optimism in terms of how individual countries are able to do this, and hopefully over time we'll be able to open even bilateral channels to be able to travel. Just as a result of, again, much better testing, tracing, and hopefully treatment.
Yeah, we all look forward to that day. So let's shift over to the geopolitical landscape. We have strains in China-US relations. We have strains between China and India. Are these strains likely to pose a threat to economic growth in the region? And is that threat likely to differ across the different countries in the region?
Sure. I have to say, yeah. I have to say, I think these threats are they're not unique just to the region itself, but it certainly is a concern for economic growth, especially again if you take the backdrop of the pandemic as well, which in many ways just exacerbates some of the challenges that would have existed before that. globalization has played a very big role in economic growth and development everywhere across the globe. Many countries in Asia and in Southeast Asia in particular have benefited significantly from that. China itself has too. I would say to the extent that there's geopolitical tension that reduces increases the frictions of supply chains, creates certain regulations that might be not so conducive for global trade. Trade and export dependent economies are naturally going to be a lot harder hit. And for better or worse, a lot of Asia has built their economy around trade and around kind of exports over time of various kinds. Supply chain restrictions, tariffs are naturally a concern. They are exogenous frictions that did not exist before some of these tensions had arisen. But so is disagreement over technology standards, which in and of itself prevents, full globalization of a lot of businesses. Two other things that we tend to look at as well that we think about. They're not directly related, but one is uncertainty. Uncertainty itself is always bad for business, and again with the pandemic that only makes things worse because policies are still being formulated kind of as we go along. The other is of course, to the extent that there are skirmishes on borders and so on, there's always a risk of accidents from brinkmanship. So there might not be a deliberate effort to get into a conflict of any kind, but we might accidentally stumble into one. And that's one of those things that we think is very much a tail risk of which the probability has risen significantly in recent times.
Yeah, fair enough. The uncertainty is always challenging for investors to cope with. Daire, how are you coping with that?
Yeah, maybe I'd just add one or two things to what Kevin's already highlighted. It's tempting to think that this trend has really kicked off just, since 2016 and the Trump administration in the US. But actually, it's been a trend that's been in place for a while. So globalization, using measures like global trade as a proportion of industrial production or other methodologies for tracking it, actually peaked in 2008. So we've actually never recovered the level of intense globalization that we had since the global financial crisis, and it's been tracking lower since then. So it's been a trend that's been in place for some time. And so I think it's a reflection probably of, changing global, geopolitical dynamics. So, China's influence in the world is growing. It's flexing its muscles. It wants a bigger seat at the diplomatic table. I think the US, having had the preeminent position for so long, is struggling to adjust to that new global picture. And that's playing out in a whole variety of different frictions. I think the trade friction is one part of that, but we'll probably see that play out in a whole variety of different geopolitical frictions in the years ahead. That likely, as Kevin said, contribute to uncertainty and volatility in markets, which generally investors can be fearful of. But one of the things that I think about a lot as it relates to this is that change is a permanent feature of investing in emerging markets and in Asia in particular. And Asia, I think we shouldn't forget, is a huge market. 60% of the world's population lives in Asia. And I think what you're likely to see off the back of this is actually even greater integration within the Asian region. So think of what Europe has done in the last 30 years. If Asia could do a fraction of that in terms of regional integration, that would be a huge opportunity. And I think you're already seeing trends in that direction. So, you've seen some energy behind the TPP, you've seen some energy behind RCEP in Southeast Asia. So, incipient signs of regional integration, I actually take a lot of comfort from. And given the size of the market here, and then you overlay on top of that China's One Belt, One Road initiative, the fact that heavily is influenced by this region and focused on that in the region, I think I'm much more optimistic that, the other side of this bumpy period could be a time of, strong regional cooperation, national champions, regional champions, and you're seeing a lot of government energy behind that. And when I think about world leadership at the moment in things like 5G, battery technology, EVs, I think a lot of it's coming out of Asia, and there's a lot of government support for that, and I think that's likely to spread across the region. So I'm more optimistic that after this period of bumpy geopolitical tension, the other side actually will be very positive for Asia.
Yeah, I think I share that optimism over the medium term at least, and I think we've got some really significant engines of growth in Asia, and China certainly being one of them. So if we turn to China, China's capital markets have been slow to develop relative to the economic growth rate, and I think whether we like it or not, we're going to see China becoming a bigger and bigger part of equity market benchmarks, for example, up from their current weight, probably doubling, tripling over the next decade at least. So when we think about that, Daire, how do you think about in the public markets, investors positioning for that? And what do you see as the things to make sure you do well and the things to avoid?
Yeah. So I think I'll probably be accused of being too optimistic or maybe Pollyanna-ish as it relates to this topic, but I actually see it as a fabulous opportunity. Now, you think of the number of companies that have come online available for us investors to put money to work in on behalf of much of our audience. It's a fabulous opportunity. Just in the last decade, the number of publicly quoted stocks onshore in China has increased by 120%. And those companies cover the whole spectrum of sectors and industries and themes. So if you're a stock picker or an active investor, that is just a wonderful expansion in the opportunity set, and it gets you excited. Now, I agree, governance in any part of the emerging world, and China is part of that, is somewhat trickier. It's a bit more labor intensive. It requires a willingness to get to know management, to validate business models, to understand supply chains, and that takes time and patience. And in many cases, it requires a heavy burden for active managers to get deep on these companies. And I think that's really the issue, that it's an active approach to trying to pick the winners from all of these new companies that are coming online. As a firm, I'm pleased that I work for a company that has committed a lot of resources to this over time, a lot of people on the ground to try and understand the ongoing dynamics at the company level, at the industry level, at the regulatory level, all of which are increasingly important. So, I get excited about the opportunity set, but I would ensure and try and help the audience really consider the fact that it's a company by company level of analysis, and that an active commitment to security selection is really important as you go through that.
Mm-hmm. While we're on the public markets, what are your thoughts? And Kevin, feel free to start with this as well. That the domestic market, the onshore market in China, many still view as retail driven and a bit of a lottery, or a bit of a casino. So, what are your thoughts as to how the current state of affairs of the market itself, in addition to governance of the companies, but the market itself, and is it still a buyer beware in terms of volatility being driven by retail sentiment, or is it starting to settle into a more institutionalized marketplace?
Sure. Our teams on the ground definitely do highlight the differences. We have very experienced investors who've invested in other markets, and as China was opening up, we had a couple of folks join the team there, and the differences are stark. It is I think a reflection of the fact that, I think like you said earlier, Marlene, China has been playing a bit of catch up in terms of the development of their financial markets, but the speed at which they have developed and the how quickly, I guess, the general population and retail investors have taken to being able to invest has created slightly different dynamics than what we might be used to in the rest of the world. At the same time, there is significant depth in the market, so that actually helps in many ways. It does create many opportunities. You just have to be a lot more sensitive to the fact that sentiment can be a very strong driver for certain periods of time. We have been able to find quite a lot of opportunities in the public markets, as Daire was describing. It is a company by company approach to doing the security selection. There probably will be a long tail of names that you might not want to get involved in quite yet, just because of the nature of the market again and the level of participation of retail. But there are plenty of opportunities that we are able to find, and that's just in the public markets. I think one of the dimensions that we tend to consider when we think about China and trying to be able to participate in the growth is because China has evolved from being, call it, almost a slightly derogatory factory of the world at one point in time to being really a marketplace for the entire real economy in both supply and demand. Also a source of investment and an investment destination. I think what we're seeing is a multi-asset approach to investing in China is actually very helpful. There are plenty of opportunities if you're able to access them on the private equity side of things. There are many companies, many technopreneurs in particular in this season that are coming up with great products and great services that will one day definitely be kind of unicorns and beyond. And being able to access those through the private markets is definitely one very, very significant source of opportunity in participating in the growth. Likewise real estate, likewise infrastructure, and even something as simple as bonds. Local emerging market kind of local currency credit, and even some of the policy bank bonds and sovereigns themselves are opportunities too. And we spend a lot of time trying to make sure that the teams actually talk to one another and figure out what's the best way to access these opportunities across the capital stack.
So as investors who, like me, were relatively small, I run 18 billion in assets from Canada. I can't afford to have boots on the ground in China. Just briefly, thoughts as to how, as smaller investors, how should we go about thinking through finding the right partners, and how do we find the right players we can trust who can help us navigate through both governance and the bottom-up security selection in an intelligent way? Any thoughts to help us around that angle?
I would say, we take that approach with many different countries, and that was how it started out for us in China as well. It was a multi-decade process to even get boots on the ground and build up a team, and the way we think about other potentially interesting markets and economies today is to say we end up having to partner with firms that either have boots on the ground with whom we've worked with before, or more recently word of mouth and referrals from other kind of peers and investors tend to be helpful as well. I think the one thing that you touch on, which is very important, Marlene, is it's almost impossible to be able to invest in a country like China without having a certain level of local knowledge. It may not require an actual physical presence, but it certainly requires a certain level of experience, a certain level of networks, connections, understanding of local policies, local culture, and that's one of the things that I think we always look out for in the partners that we work with. And increasingly, we've been able to actually find people on the ground, kind of work with them, hire them, have them join the team as well. But again, that's something that takes quite a significant amount of effort and time. And if it's not available to everyone else, there are plenty of good investors, there or in the region who understand the market and can help.
Thanks. I'm working on that. Daire, maybe we'll turn over to ESG. We've talked about governance and some of the challenges around governance, particularly in China and in some of the more emerging markets in Asia. Let's turn to the rest of the ESG, and in particular, some of the E, I would say, and the S. And it's increasingly important in Asia. And so talk to us a little bit about what kinds of considerations related to ESG risk and some of the efforts around ESG investing that you're observing in Asia. I know you have lots to say about this topic.
Yeah, it's a topic I'm really passionate about, and it's become increasingly important in Asia over the last 5 years or so in particular. You've both mentioned the retail focus of the investor base in Asia, and actually that's one of the challenges. So there's a lot of investors putting money to work here, small ticket sizes, high turnover, with not a lot of interest in engaging with management. Actually, so that really gives everybody that's listening on this call that are institutional investors a wonderful opportunity and actually a big advantage, in my opinion, because engagement in Asia really works. And what we've found is that companies have an amazing willingness to partner with investors, large institutional investors, to understand what best practice is in other parts of the world and to seek to make positive changes. And that can have very positive portfolio implications. I can give a few examples of that. But I think it's just become a really big and powerful trend. I think it's a trend that we want to be aligned with. And there's just a lot of inefficiencies in the market, and not least of which is reporting. So reporting in Asia tends to be patchy. So that's, the third-party providers. Once you start getting down the cap spectrum, the overall level of coverage can be a little bit mixed. The companies reporting their own data themselves don't always do a particularly good job and help themselves in that respect. So what I think is really needed is a willingness to engage with companies, to help them understand what's expected, and then partner with them to make those changes. As a small example, we're investors in a large wind generator, probably one of the largest in the world, based in the Asian region. And they have a small fossil fuel exposure that was being misreported by a third-party provider. And we engage with them. We talk to them a little bit more about it, help them understand the importance of making a change and a correction to that reporting data. And as they did that, and the numbers started to improve from a carbon intensity perspective, that actually opens them up to be invested in by more and more companies, which is a win for us as investors and our clients over time. So I think that's just one small example of the inefficiencies that can exist in the marketplace and the potential rewards available to those willing to engage with companies around the region. The last thing I'd say is that it's become more and more important for citizens around Asia. So we do a lot of Baidu surveys in China to get a pulse on the general population of what's important for them. And in the most recent round of surveys we asked a question related to willingness to pay more for electricity or consumer goods if they are generated in a clean, sustainable way. Over 90% of respondents said they would be willing to pay more, and for consumer goods, up to 20% more.
Wow.
For clean product and generated in a sustainable way. So, the tide is turning. Consumers want better and more responsible manufacturing processes and an approach. They want a greater focus on the environment. I think over time that will pressure companies to come up with the solutions. And all of us on this line as institutional investors have a unique opportunity to make that change happen, and then ultimately over time to benefit from an investment standpoint.
Thanks, Daire. That's a fantastic perspective. What a statistic that is, and that is undoubtedly going to be a tidal wave of initiatives as a result. Consumers often drive the boat. Kevin, further thoughts on this topic?
Yeah, I would echo a lot of what Daire described. I mean, I think the change in sentiment is something that is very palpable. Having left the region for a while and come back, even in the last couple of years, the shift in the narrative has been significant, and I think it's driven by a confluence of maybe three different factors. One is the actual recognition of the impact of climate change and the effects it's going to have on all of our lives at the individual level. And that comes together with the fact that metrics have come a long way to be able to help us actually kind of measure, understand, and express the issues that are coming about. And kudos to other parts of the world, maybe especially Europe, maybe Canada as well, for having established a lot of best practices of what we can actually do about it. And the confluence of all those three together, I think, is what's driving the ability for the region here to also be able to, again, kind of recognize, measure, and then think about doing something. And it's reflected, in general kind of public sentiment. It's clearly reached a certain level where governments themselves are also feeling the need to respond, even if they were somewhat hesitant about it before. It's often kind of portrayed as a trade-off between kind of economic growth and kind of climate change. initiatives. But I think these days there's a lot more recognition that there's a lot that is actually aligned in terms of what we can do to make a difference to the environment and still be able to participate in economic growth. This is finding new ways to be able to do so. And that's something that is definitely, I think, a very strong trend in the region.
Yeah, fantastic. So this has been a fantastic session, and we've covered a lot of ground from COVID and its impact on the economic growth to investing directly in China as in public or private markets, and touched on the importance of ESG, and all of these trends are critical for us, as I think, for Canadian investors to keep in mind as we have to. I think we're going to be forced into expanding our investments in Asia as that part of the world continues to grow. Back to you, Caroline.
Great. Well, I was listening intently. It was an excellent discussion. Look, I want to thank you so much, Marlene, Kevin, and Daire, for the excellent insights and for joining this really important panel. And thanks to everyone for joining us here today. Don't forget to join us next week for our next Monday Minute on sustainable investing, featuring Alison Lote, who is Managing Director of Sustainability at OP Trust, and Ted Maloney, Chief Investment Officer with MFS. I hope you'll be able to join us again, and I thank you so much to all of you for being here today. Thanks for the great insights. Bye, everyone.